Hola, it's Joe Partavila. Welcome back to the Forbes Books podcast. And you know, when it comes to building wealth, the average Joe or Jane has two options. And no, I'm not talking about winning the lottery. They're earn an income or invest. The former is pretty obvious, but the latter could be complicated. That's when you need a little help from your financially educated friends. Joining me this week is the president and founder of Horowitz & Company and the author of The Disciplined Investor, Essential Strategies for Success, and the host of the Disciplined Investor podcast. His name is Andrew Horowitz. Andrew, welcome to this podcast.
Joe, thanks for having me. Appreciate it.
You're very welcome. And let's start by, I want to key into the adjective in the title of your book and podcast, disciplined. Yeah. I know what the dictionary definition is, but what does it mean to you when it comes to investing?
You know, the problem with investing for a lot of people is that you're dealing with something near and dear to your heart. It's all about money. And the thing is that money, while we know it doesn't bring happiness, some money doesn't necessarily bring, unhappiness either, right? I mean, if you have money, there's a lot of things that you could do and maybe places you can go, things that you could buy. The idea that we're all programmed that one day we're going to retire. And the problem is that a lot of people get really emotional when dealing with their own money. They see the markets going up, they see the headline doing this, they see the fact that this one stock, there's a change of a CEO and all of a sudden things happen and they get very emotional. So one of the problems is that when you do that and you react, it's a problem because you make bad decisions. Well, the idea of being disciplined is to have some kind of a plan that is put into place. And oftentimes I say, you want to write it down. I mean, as simple as that is. What am I going to do if this happens? Where am I going to go? Or how am I going to handle this? And keeping your emotions in check is really an important part. It's always going to be there. You're always going to have that bubbling up over time. But being disciplined, you have a core set of principles, ideas, and ways of investing in getting you to where you want to be eventually, which is obviously, financially secure and financially independent.
And with your company, Horowitz & Company, is that one of the things where and sort of the inspiration for the book was, I want to write something where if you meet a prospective client, you're like, hey, listen, here it is all in this 220 page book. You can understand what we do here, because essentially this sort of captures what you guys do day to day, correct?
Yeah, it does. In fact, when I was writing this, when I thought about writing this, the idea was, let me just get down all the things that I've been doing for years and let me figure out, okay, how are we going to replicate and have it as kind of the investing Bible in a way for what we do. Now, there's a lot of different ways, and over the years, things change. Disciplines change, and they get kind of, I would say that back when I first was doing research, it was on Saturdays and Sundays where you'd have to go and find certain newspapers or certain periodicals and do the research. And then, that internet thing came about.
Yeah, I heard about that. It's popular.
Yeah, and that came about. It's like, we can get the data much better. And so, you adapt, you adjust, you change with the times. But the core principles of how you want to look at things using this quantifunda techna, which is quantitative analysis, which is a fancy word for screening and filtering out certain aspects of a particular stock, or specifically looking at a mutual fund or an ETF that meets certain criteria. And this all could be done oftentimes for free on some sites. And I wanted to put it down and have a record of it so that we could reference it. And yes, it's good for people to understand that we have a way of doing things. It's not, hey, I feel like today let's buy the electric vehicle stocks today, or let's buy Coke and Pepsi look good, let's buy them. There's more involved with the whole process, and there should be. It doesn't have to be necessarily terribly tedious and overwhelming, but understanding the fundamentals, understanding the technicals, the charting. What does a chart mean? What does it mean when we have a breakout above a resistance? What does that concept mean? What's a moving average? All those things kind of I want to put down.
And you mentioned quantitative analysis, and in the book you do a great job of breaking down investment analysis in these three buckets. One was quantitative, the other technical, and fundamental.
Right.
Now, I guess my question is, you have these three things that you've laid out, but do you have to master all three to become a disciplined investor, or can you key into one or two that fit your strengths?
So the quick answer to your question is, I think you could master something that is right for you, because here's a problem. This is really interesting that you picked up on this, because There are those that are fundamentalists. They believe in the fundamentals, the underlying financials of a company. Like, okay, is this company have good management? Are their earnings growing? Do we see that there's a consistency over time, that they're building innovation, and they have all of the earnings and revenues that are doing well, and all the different statistics? Well, those people oftentimes are those that are willing to take a company, understand it, and then invest in it and hold it for a while. Now, for some people, they're like, well, wait. I don't know what's happening with this company, and I'd much rather look at a chart, the technical side, and forget about all this other stuff. I don't want to deal with having to try to be an actuary and understand all the numbers because it's kind of complex, and who knows what you can believe and not. I'd much rather just look at price and figure out if price is truth. In other words, if a stock is starting to move in a certain manner and is breaking above something or breaking down, or if we're seeing that there is a specific pattern that's developing with maybe volume and volume at price, well, that's what I'd rather use. But some people can use either one. Some people can use both. Some people cannot use one or the other. And when you try to put somebody into an investment process that doesn't fit their personality, it's not going to work.
It's sort of the round peg, square hole kind of
Sure.
thing, right?
Yeah.
And so it harkens a lot to me, being a sports fan, is sort of this Moneyball analytics aspect of it, where a lot of teams now are foregoing the fundamental analysis of it, and they're just being strictly about the numbers. Whereas, as you know, Andrew, human beings are not stocks. They depending on what's going on in their life, or maybe they're having relationship issues, they may not have the same performance that day or that week because of what's going on in their life. So how do you talk to people when it comes to like the math nerds who are like, I just want to be all about the math, and sort of stress to them, listen, it's important to know all the data and the facts, but you almost sometimes always have to use that gut, right? Because it can't just all be about the numbers.
No, I can't. And not only that, we know that about 80%, give or take a little bit, of a stock's movement is really all about the directionality of the overall markets. Because these days, especially where we have so much of passive investing, these ETFs that just invest in an index, the correlation of a stock's movement is very high when it comes to what the actual overall market is doing. And therefore, you could do all the fundamental analysis that you want, but back in March of 2020, you could have had the best company in the world. Meanwhile, this thing is down 50%.
Right.
And, what did the fundamentals do for you during that period? They may have said, hey, you know what? I'm not selling this company, and that may have turned out very well. But you know what? The cruise lines had great fundamentals going into March of 2020. Things change, but you don't really know till sometime after. Therefore, you have to then take into consideration, okay, what's the chart telling me? What's the chart saying about this? And then if it is a solid company, maybe I'll look to pick it up on the backside once the chart is now going to be showing me there's a bit better of a situation there, and it's a much more opportune time to invest.
You brought up the pandemic, so I'll go there. How much of a barometer do you think the stock market is when it comes to our economy? And the reason I ask this is because, you've seen this existential threat that we face with COVID, yet after that bottom in March, April, the market's been booming since then, yet people are dying, cases are going up, and these people who are involved in the stock market are making money.
Yeah.
What can you try to, because you're obviously a lot smarter than I am when it comes to investing, how does that make sense in this world?
It doesn't. First,
okay, good. Thank you.
It doesn't. However, let me just tell you what's really going on. I think that's really pretty easy to understand if you really just kind of step back for a second. Number one, is the economy doing better? Statistically, yes. Let's look at the unemployment without getting into the weeds here, but we saw that it went from a 6.7% to a 6.3% this month. However, the numbers in the last month were a negative print on new additions to the jobs rolls, and this month was only 49,000. Somehow, magically, we went from 6.7 to 6.3. Well, what's that about? Well, even Jay Powell, the chairman of the Federal Reserve, said, when we look at these numbers, you really need to understand that this is a statistical calculation. And I once had a teacher, Mr. Eckstein, back in high school. And he would always say this phrase all the time. He would say, figures don't lie, but liars always try to figure. And he was talking about statistics and statistical facts that are behind how you calculate something. And when you calculate the unemployment rate without, again, going into the weeds on this, there's labor participation rates and all this stuff going on. And the whole thing about when people fill out the unemployment forms saying, hey, I'm not looking for jobs anymore. Therefore, they're out of the jobs market. Out of the jobs market means we don't calculate them. Therefore, we can have a lower unemployment rate. So he's saying that even we're close to a 10%. But when you sum this all up and say, why are stocks going up? Well, I can give you a good answer on some technology companies, pull forward of technology advancements to companies like a Zoom or a Microsoft or even Netflix, right? We're all watching TV from home. But even the other companies, right? You see this big boom, 60% off of the bottom from cruise ships, and airlines are doing much better. We have massive amounts of stimulus. That stimulus is finding its way into the stock market because you can't put money into a savings account if you want to earn any money. 0.2, 0.3% maybe. We call it TINA, T-I-N-A. There is no alternative. And with that, people are saying, well, look at how great this is doing. And every time we've seen a stock market crash, you know what? Boy, the Fed is there at lower interest rates than ever. And on top of that, we're seeing 900 billion, 2.2 trillion, then another 1.9 trillion, talking about an infrastructure plan, talking about another 3 trillion after that. The Fed bought $4.5 trillion worth of bonds in a quantitative easing or money printing process. So the money is finding its way into the markets. It's very low interest rate environment. Companies are able to react and profit by cleaning up their balance sheets, cutting down on their overall debt service because interest rates are low. So it's a really good time weirdly for a lot of companies. And the other thing you have to know, I think it's really important if you haven't figured this out yet, ingenuity. American and other countries around the world, but the ingenuity of many of these companies to weather these kinds of storms. It reminds me, not to go too far afield here, but you see these devastating rainstorms in Texas a number of years ago. Remember those? Mm-hmm. Horrible. And you think, oh, how are they ever going to come back? Now, if you want to step back and think, okay, where's the opportunity here? Wow, wait a second. Massive insurance payments are going to come into the system. Home builders are going to do pretty well. Lumber prices probably going to go up. Copper prices also. We're going to see people have to replace stereos, cars, and all that. Man, there's an opportunity here. And it was incredible. As a matter of fact, natural disasters are a great addition long-term to GDP, as crazy as that sounds.
Sort of punctuating something you said there, you mentioned all the things that the government does to help these companies, whether low interest rates, all this stimulus. Don't you see, though, that's why people sometimes feel like the system is rigged against them? Because, wait a minute, all of these people who are obviously already wealthy are getting help, whether it's tax breaks, stimulus, and all this. And then you see small business America just dying on the vine. Is there any way to fix that, or just the way it is? The old adage, it is what it is.
Yeah, I mean, first of all, you asked me why. You didn't ask me how I felt about it, right? So I gave you the whys.
Yeah.
I find this disgusting. I find the fact that we are seeing that billionaires and millionaires becoming billionaires, and companies are making profits, incredible amounts of money off of the backs of people who are suffering through all of this and have no choice but to play by the rules, where a lot of places don't. We saw tax cuts for major companies, but yet we're, having the situation where we're not paying any less taxes. Or how about the fact that while there is no inflation, everything costs more?
Right.
This concept of the government, the Fed saying, hey, you know what, we'll keep on funding low interest rates and doing all this bond buying because there's no inflation. But I don't know about you, Joe, isn't everything costing a lot more than it was?
It feels like it, yeah. And on to my point about the rigging, let's get into this GameStop thing. Obviously there was, without getting too far field on it, about what happened and how it blew up thanks to the Reddit.
Wall Street Bets.
Yeah, Wall Street Bets. All right, so fine, this happens, they drive the stock up, but then a company like Robinhood stops the everyman who's just trying to get into the stock market from acquiring stock, so or selling it. Doesn't that, again, on top of what I was talking about, the system being rigged, now you have a company not letting regular people buy and sell this particular stock for reasons only that are important to the company, but not their customers.
So I'm not exactly sure what happened there, but there was a lot. It was not just Robinhood. It was other companies too. You could not open new positions in GameStop. People were over leveraging, and they were. You saw what was going on. It was more than a feeding frenzy. It was hysteria. It was hysteria that GameStop was going to level the playing field of the everyday guy and gal out there compared to Wall Street. Now remember, they were pounding their desk that, you know what, GameStop is the way we could break Wall Street, that we can go after the hedge funds and really do them in. I'm thinking, could you imagine a hedge fund saying that we're going to bust the retail investor? Now, maybe they do that here and there, but that would be a problem. But it's okay because people, it's going up and people are making money. Now, the whole time I'm watching this thing, I was like Lurch. This is not going to work out,
Yeah.
And it didn't, by the way, and it's not going to. That can't. And it was a pump and dump scheme. Who knows who was really behind all of it, by the way?
Right.
We don't know if it was, Roaring Kitty. That guy from, I think it was Boston.
Yeah, the YouTube guy.
Yeah, he's going to him, or was whatever it was. But I mean, when I start hearing people that I never heard talk about stocks, say, "Oh, we're buying GameStop," I'm like, "What? Well, why?" The whole idea behind this was this social outcry that Wall Street has wronged us for years. And I'm saying, wait. Aren't you the guy that took a stimulus check 3 months ago, put it into a Robinhood account, and decided that you're a professional trader now? And how did Wall Street screw you for the last 20 years? I don't understand. You weren't even involved in any of this. Right. So the problem is that first there was an obscene amount of short interest on it. So you know what? It was a target, and it should have been, and rightfully so. If the retail investors didn't grab that, the institution should have. There was some mismatch in what was going on there. The outcry, though, I think was a lot louder, and it goes right back to your point about how the system is rigged, and people want to get in on the payday, and I still, we have to find an investigation of exactly what happened, because there's a lot of discussion about, well, Robinhood shut it down, but the problem is the risk was too great for them to bear. It could have broken the company, and then where's everybody else? Right. The whole idea of trying to burn down the system is like when you see these riots and people are burning down their own houses. Why does anybody do that?
Yeah.
Well, burn down the guy next door. Why are you trying to burn your own house down? Yeah. They were trying to burn the house down, and that would have impacted them as well, whether it was the 401k plan, whether it was their Robinhood account. They were at a point where Robinhood had to get a cash infusion of billions of dollars because they weren't meeting their regulatory requirements. It was just totally leveraged to a point that was really bad. Now, I'll say one other thing.
The optics of it, but Andrew, the optics of it are terrible, right?
Terrible. Yeah. Absolutely awful. It looks like, that the retail guys got a major screwing because they were messing with Wall Street.
Right.
That's the optic. I don't necessarily know if that was what happened. Not that I'm on either side. I'm all in favor of people making money. Go for it. You want to play? Have at it. But let's not be stupid about it as well, thinking that GameStop, a company that looks like it's about to go bankrupt, a company that, by the way, couldn't even do a secondary offering for some reason during all this to bring in money. They could have paid off all their debt and been in great shape. They didn't do a secondary through all this. And it just, stupidity was going to be the holy grail of everybody that's investing it somehow. And he even had guys like Mark Cuban coming on TV trying to rationalize the valuation at $400 a share. I'm like, whoa. What? And then you have a guy like Chamath Papa, I can't say his last name. It's Papa Dibadia.
Yeah.
He's coming on saying, yeah, you know what? I bought some of this too, trying to pump the whole thing. And even Elon Musk saying, yeah, I bought GameStop, let it go. Like, what? These are like Pied Pipers these days, this trio trying to be kind of folk heroes in a world.
Do you think they're just playing to a crowd, though, there?
Yeah.
Because obviously, those guys you mentioned are all billionaires, so them buying GameStop stock will not affect their life in any way whatsoever, but it does play to a crowd where, like, oh, yeah, Mark Cuban's on our team. So there is that factor to it. But do you think now, because of something like this happening, right now there's nothing in place to stop it from happening again? Will I don't want to get all Big Brother-ish here, but will Big Brother all of a sudden set up guardrails to prevent this from happening in the future?
So what part of it? The part where people were bidding up stock of a
Yes.
company that was, we've seen this before in history, and it always ends badly, by the way. It just does. So I'm not sure what guardrail it would have been. Was it been that they were prevented from buying? It's like, you know what, if people want to gamble, and it's legal, and they know they're big boys and girls, they can lose a lot of their money. We can't stop that. The guardrail about, okay, if things get too hot, do we stop trading? I mean, halts happen, although that's across the entire market spectrum, not just on one firm.
Yeah.
I have always been cautious on my podcast, the Disciplined Investor podcast, about Robinhood from the day they started. I said, this is not a game. This is not a gamification of the investing process. And if you go down that you know what? Do it down that lane. Do it at your own risk. The whole idea of what Robinhood has created in all this was setting the stage up for what happened.
And you talk about risk management in your book. And, luckily for us, the markets haven't been too volatile for a good stretch before the pandemic. I mean, you had the crash in the 80s, dot bomb early 2000s, 08, 09 recession. So talk to me about risk. Is it, how risky is it? If you are a disciplined investor, can you mitigate risk?
There are ways to mitigate risk. The first line of risk management is a concept, and that is, what's your time horizon? And this may seem a little bit ridiculous, but if you think about it for a second, if you have a chart of a stock or an index, whatever, you put it on a currency, I don't care what it is, Bitcoin, you put it on you're looking at a chart and you see it going up and down, up and down, up and down. You're like, wow, look at that. The price moves here, it moves there, it's all over the place. Take that same chart, let's stretch it out for a day. Let's stretch it out for a week. Let's stretch it out for a month. All of a sudden, those peaks and valleys look a little different. You're like, well, if I would have held it from here, I would have bought it $3, and here it is at $62. Yeah, but that little dip right there, well, that dip could have been a 30% dip. And at the time, it felt very intense, overwhelming. But it's all about the first concept of what's your time horizon and how do you mitigate the risk? Well, time in the market sometimes versus market timing is a way to do it. The second thing is diversification. I talk about this in my book. I talk about this a lot. It's this whole idea of a flower garden. If you think about a flower garden, depending on where you live, I'm in Florida, but up in New York, you plant things in the summertime. You plant impatiens and they come up, they look beautiful. You have maybe some roses, maybe you have some tulips, maybe you have some evergreens. Those are kind of like they stay green all the time. But you want something that is blooming at any given time of the year. Now, as opposed to a flower garden that you only have impatiens. If you only had impatiens up north during the summertime, in the winter, your flower garden is going to be a big flop of dirt. That's all it's going to be there. That is not how you want your portfolio reacting to different storms and weather that's out there. You want to make sure that you have a very diverse grouping in there that is uncorrelated, so that something's blooming at any given time. So, for example, you want to have things like uncorrelated assets to a degree that are alternatives, and there are a lot of various mutual funds and things like that you can buy in that range. You want to have some dollar assets and non-dollar assets. You want to have some domestic and international. You want to have commodities in there, some real estate inside of there. You want to have small caps, large caps. You want to have some bonds as a buffer, and depending on where we are in the cycle, now that we have an increasing interest rate environment that all of a sudden started happening over the last few months, you want to make sure you do not have bonds that will be hit too terribly by interest rate risk. And you could do that by changing what's called duration and maturity on your bonds. Not a very, very hard concept, but the concept is to have true diversification. Diversification is not having Apple, Netflix, Tesla, and Google in your portfolio. I have 4 stocks. Look at that. That's great, because they pretty much will react the same in different market conditions. When tech is hot, they're going to do well. Tech is not, they're not going to do well. So you want to have differing asset classes inside of a portfolio. And depending on how you do that, you can smooth the returns, or at least the intent is to smooth returns over time, so that while you may, in an undiversified portfolio, get to point B at some date in the future with maybe a lot of volatility that may spook you out here and there, you may get to point B also with the diversified portfolio without all the headache.
And I want to dig into something you mentioned. You did mention mutual funds, and you do write about it in your book. But I'm seeing a lot of this trend where people are saying that ETFs
Yeah.
will take over mutual funds, ETFs, exchange traded fund. Talk to me about the difference between the two, and do you agree with that assessment that ETFs will soon take over mutual funds?
I mean, I think because the trend is there and you have the mouthpieces and PR agencies with the ETFs about this, there are some definite benefits with ETFs, and I do like them. We do use them as a part of our portfolio, but not absolutely in place of an asset class. So in other words, we use mutual funds and ETFs. The differential is this. There's a lot of differences, but mutual funds are also required to pass through certain capital gains at the end of the year. ETFs are a little bit more tax efficient. However, mutual funds oftentimes can be either passive or they can be non-passive. In other words, they can have a manager that is choosing. They could choose what's going on. What we like is a mix that brings us a passive or an index-based strategy for markets that are efficient. So, for example, the S&P 500 or the large cap universe in the United States, that's kind of an efficient market. So why try to fight it? Pay the lowest cost possible. Let's get an ETF, be done with it in the area you want to be in. However, you look at things like emerging markets. And when I start investing in emerging markets around the world, whether it's Asia or Latin America, I want to have somebody that understands the political system, the tax system, the language, understanding the differences in how companies operate in the various regions, and have a team of managers, of active managers that can provide me with the detail that I need. And a mutual fund fits that bill very nicely. So there are certain parts of the equity universe or stocks that I like to utilize mutual funds, even though they're a little bit more expensive, if you will. But the second part is, we've done some studies on this, and I post them on our website. When we look at the fixed income or bond universe, which people don't, the eyes gloss over when you talk about that a lot. Like, oh, what do I want that for? Well, it kind of works in a portfolio pretty nicely, a constant income, et cetera. Well, when we look at a bond universe, there's inefficiencies in there much greater than equities. And those inefficiencies we can capitalize in a mutual fund. We did studies with 3-year rolling returns, statistical analysis of risk, cost factors included, and basically the mutual fund universe of active versus the passive won out. And that's because when things happen in the bond market, like, for example, you have a major sell-off in bonds. Well, the index ETFs are forced to just sell at any price, to sell. Well, the mutual fund manager is like, hey, look at those prices over there. Now, we may need to sell. We may have some cash here. But you know what? We can move our portfolio around a little bit differently than the ETFs. Look at that price. That price is 10% lower than it should be. I'm going to pick that up from the ETF guy. So there's kind of a different process when it comes to fixed income, especially. So I think there's a very good reason and a rational reason for having both. If for whatever reason you're just flying the flag for just ETFs only and you're just maybe an equity player in the US, okay, have at it. But when you start adding complexity to the portfolio, I think it makes sense to bring in some very seasoned mutual fund managers, try to get the institutional class, low cost, try to make sure they have a peer history that is well above their class, make sure their risk-adjusted returns and Sharpe ratios and all the different Morningstar things that you see out there are top-notch, and build your portfolio. Again, diversifying. Back to our diversification discussion. ETFs, mutual funds, bonds, stocks, small cap, large cap, domestic, international, and kind of blend it according to what your particular taste is. Some people can't sleep at night with knowing the markets are moving around. Some people sleep like a baby.
I noticed you mentioned stocks, bonds, mutual funds, ETFs. The one thing you did not mention is cryptocurrency. And as of this recording, Bitcoin surpassed $50,000 for the first time. And you're seeing a lot of companies, the aforementioned in this conversation, Elon Musk and Tesla getting involved in it. What do you see about, when someone calls you up and says, Andrew, what do you think about this Bitcoin? Is this something I should get into? What is your initial response to that question?
So I think Bitcoin and cryptocurrencies, but let's stick with the majors for a second, the ETH, the Bitcoin, and a couple others out there. But it's interesting. Is it going to become an alternative currency? I think not. As a mainstay of what we do. It's very difficult still to spend money utilizing Bitcoin. And yeah, it trades 24/7. 365. There's three components of cryptos that I think, or particularly Bitcoin, that we have to look at. Number one, and the question, is it a store of value? Number two, is it a currency? Number three, is it an investment? Number one, is it a currency? I guess in a way, is it a currency that I would hold for my clients? Let me ask you this. If I told you your cash position could move up and down 5% in a day, and that's what we're going to hold our stable cash position of your portfolio, what do you think clients would say to me?
That's not good?
No.
Okay.
In other words, I have cash that is sitting on the side, money that is readily available to buy things. Now, what if I want to buy this stock and all of a sudden my cash is down by 6% for the day? Now, all of a sudden I have to take convert it to buy that stock. I'm not sure I want to be involved in something like that. And maybe because people say, well, you're comparing it against cash. You're comparing it against the dollar. Oh, yeah, that's what I'm comparing against because that's what our core, what's in our pocket. The second thing is, so cash alternative, not really, not a real currency alternative as the core. It's not going to be allowed by the governments. They want to control everything. They need to set the money flow of what's inside the establishment, if you will. The second thing is store of value. Well, is it a good store of value where I could put some safety, like an alternative to gold or silver or platinum, palladium or something else, maybe even to a degree, maybe some raw land, maybe? It's interesting. It's possible. But again, the volatility right now, the limited nature of how many coins will be out there, the religion aspect of it makes it questionable. As an investment, if you want to invest in it to try to make money for the future, and whether or not means trading it or buying it and holding it, hey, have at it. I'm all good with that as an investment. It's difficult to invest for clients due to the lack of regulatory environment surrounding it. It's also difficult for me to invest for clients because if a client, so Joe, if you said to me, hey, tell me, how is the value of Bitcoin derived? I'd be like, it's worth 50,000 because, what's backing it?
Blockchain. You got to throw those fancy words around. Blockchain. Blockchain. Well, it's funny too that you mentioned that, Andrew, because I got into it when it was 20,000. So this is probably like 2 or 3 years ago. And then, as you know, it bottomed out, and I'm like, I got to get out of this. This is not my thing. And then obviously fast forward 2-3 years later and is now up to $50,000. And I keep seeing people like the Anthony Scaramucci's of the world who are supporting it with his Skybridge Capital Fund that they're saying, listen, get in now before it's too late. That is the one thing I guess that will probably pique a lot of people's interest because no one wants to be that person who's like, passed up buying, Google stock 25 years ago or Apple stock 25, 30 years ago. Do you see this rush where you'll see people like, I don't want to be caught out in the rain because I had a chance to buy Google years ago and I passed up. What do you say to those people who like they just need to get into it because they feel like this is going to be that next thing? Yeah,
so I've had Anthony Scaramucci, or the Mooch, on my show before, and in full disclosure, we actually used one of his Skybridge funds for some clients. But remember something, he recently started this crypto fund, right? And he is a pretty good marketer, and he's pretty much going around doing the dog and pony show right now. And what is he trying to do? Well, he's trying to fund that investment vehicle that he makes fees on. So going around and saying all of a sudden, right? All of a sudden, isn't it amazing that the correlation between his love of cryptocurrencies and them establishing a new cryptocurrency fund is one and the same? So
you're saying take that stuff when you hear the Elon Musks of the world, when you hear the Anthony Scaramucci's of the world, take it with a grain of salt because you don't know what they're, I guess for lack of a better word, just what's in it for them.
Yeah, I mean, this whole thing's a giant pump deal. Not necessarily pump and dump right now. But there's religion. Once you start getting the religion behind it, like this is the only thing that's going to be the savior of the world, because all of these central banks are debasing the currencies and you're not going to have anything left. I mean, we've heard this for years. There's the same discussion of gold bugs, but everybody now gets to do it digitally. It's more fun on a computer. It's more fun on an app. You can see it all the time, exactly what the value was, and you don't have to carry around, 300 pounds of gold with you. So this is the story of what the gold bugs did for many, many years. There's this religion behind it. There's a kind of, if you say, don't say anything bad about it.
Yeah. No, it is.
Don't say anything bad about it because, first of all, they'll block you. They'll scream. They'll go crazy. I think there's a place for all of this. Do I think that Elon Musk taking $1.5 billion, putting it on the balance sheet of the company? How about this? Broward County, Florida here, Dade County, talking about utilizing Bitcoins as a currency to pay certain taxes or certain bills to the county. Now, how does that work if all of a sudden the county takes in $5 million and Bitcoin, which could happen this weekend, is down 20% over the weekend?
All right. And lastly, for 4 years, and we'll get slightly political here, but for the last 4 years, Donald Trump said that he alone was the reason that the explosive growth in the stock market happened. Not to say that Obama did nothing, apparently. But now we have a new president in the White House, and Trump sort of used his normal fear tactics of, if you get Biden in here, the economy's going to crumble, stock markets are going to crash. So you, as someone who's on the inside, sees how things play out actually on the ground, what does a new administration mean to people's IRAs, 401ks, the stock market? Do you see the same, the train chugging along? Do you see it slowing down, speeding up? Give me your thoughts on that.
So there's a couple of things. I mean, the big thing that you need to credit the Trump administration with is some of the regulatory rollbacks, as well as the fact that they reduced the tax rate for corporations. Okay, that was a big issue to help profitability of companies, and that just kind of really helped to accentuate the growth pattern that we were on for 8 years prior or 10 years prior to begin with. And of course, the Fed having very low interest rates, that always helps. So this administration seems to be just saying, you know what, we're never going to let a good crisis go to waste. So let's try to figure out how we can take our agenda, which is, a green agenda, as well as, given to the people, and pour money and just pour money into it. So it seems like the question about, well, what happened to like deficits? What happened to the fact that we don't want to have these big debts outstanding? Our deficits in the multiple trillions higher than ever it's been. So as long as we see that there's a very cooperative Fed, as long as we see that, and they say that rates will stay low to 2023, as long as we see this constant money being pumped into the markets or the economy, it's going to be very good. And this is a global phenomenon, not just here. Their green initiatives trying to electrify and change all the cars in the federal fleet to EVs in the next 3-4 years is going to be pretty good for certain areas of the market. Looking at clean energy alternatives is kind of an interesting play also. The big issue you have to watch for, though, Joe, is when they say, well, we want to rein in the billionaires out there. We want to have them pay their fair share, and we're going to be raising taxes because we got to pay back some of this. And when we start seeing them talk about regulation rollback of the rollbacks, okay?
Yeah.
And when we see them talk about higher taxes for corporations because they could, the old fair share, pay their fair share, which frankly they should probably.
Yes.
And it doesn't matter if you if you roll taxes for corporations from 20, I'm just going to pick a number, 10%, let's say, to 20% to 30%, they're still going to figure out ways to pay as little as possible.
Right.
So the number is really not that important. It's all about the tax code and how that's playing out. So I think there's a little bit that we need to be concerned about, that valuations have gotten well ahead of their skis. And you have to look at that with everybody saying, the narrative for the last number of months has been, hey, wow, look at those valuations. But, interest rates being as low as they are, it's okay. Because when you do the calculation of a forward discount model and you look at risk-free rates of return, you do all this stuff, and hey, you know what? It's justifiable. But now when all of a sudden rates go from 0.65% on the 10-year back in October to 2 or so today, and the narrative says, well, higher rates are good for stocks because that means we have growth ahead of us. Like, wait. So low rates are good for stocks because you were really pounding the pavement on that, right? And high rates are good for stocks and you're pounding the pavement on that. So in other words, everything's good for stocks. Is that what you're telling me?
Yeah, right. Well, it is funny. It sort of loops back to our initial conversation about the system. The system, it's like Jurassic Park, life always finds a way.
Mm-hmm.
The system will always find a way no matter what.
Right. That is very correct. I couldn't have said it better.
His name is Andrew Horowitz. He's the president and founder of Horowitz & Company and the author of The Disciplined Investor and the podcast, The Disciplined Investor. Andrew, thank you very much for the time. I really appreciate it.
Joe, keep up the great work. Thanks so much.
And if you'd like to connect with Andrew, go to thedisciplinedinvestor.com. And that wraps it up for this edition of the Forbes Books Podcast, available for you to listen to and subscribe to on Apple, Spotify, Amazon, or wherever you get your podcasts. And please, don't forget the golden rule and treat others as you want to be treated. Thanks for listening. Until next time, adios.
This has been a production of Forbes Books Radio. Find out more at ForbesBooksRadio.com.